The real problem that I see going forward for y'all is cash flow and planning your cash flow. Being in the position that you're in now is a good position because you're in the position where your values are going up faster than the state knows what you're collecting, because they're operating on a year behind basis, basically. They're saying, okay, pay us this money back from what y'all levied last year. And so as long as your values are going up, you're going to be ahead of the game cash flow wise. But at some point in time when the oil values level off and begin to decline is when y'all really need to make sure to plan your cash accordingly, because that is when you'll be in a position of owing more money back to the state than collecting in tax dollars when you're in full recapture, which is what you're fixing to be in. You're not in full recapture yet, but that's where y'all are going. From all indications, and I'm sure y'all have been given the same indications as well from your tax assessor and appraisers, that values are not going to go down, they're going to continue to escalate. And so in the short term, that's a good situation for y'all to be in. The bad problem with that, as far as having so much money, is you have nowhere to put it. And nowhere to earn any rates of return currently on your investments. Whereas in a normal world, y'all would be able to earn bukus of interest income on that money that you're holding for a year until the state says we want it back. And so that as you go forward will be something that y'all need to keep an eye on, be made aware of, and plan that we may have $3-4 million in the bank, but where will we be 2, 3, 4, 5 years down the road with this money? And that's what a lot of schools around here are struggling with right now. And it's hard to educate the taxpayers to that you know, you are collecting all this tax money. You ought not to have any taxes set to it. Your tax rate ought to be 0 or 2 or 20 cents or whatever. But you can't operate like that, because the state will take that money, whether you levy a tax rate at $1.04 or 99 cents or 20 cents. They're going to assess recapture on y'all based upon a $1 tax rate, regardless what your tax rate is. So that's just to get out of the way going forward, because this is a new area for y'all, as it is to all the schools down here in the Chapter 41 arena. And it's an arena that quite personally I've never seen before in my lifetime. Values come and go the way they're going, and tax attorneys that I've spoken to have all said the same thing, that they have not either. And but it's quite an issue that until the state changes their funding mechanism, it's going to be whatever you collect in taxes is going to end up going right back to Austin, because you're going to owe them more than what you're going to collect. As we look at the audit, y'all have all these pretty bound hard copies in front of you. TEA does not want one. They sent out a letter in September saying we are not going to take any more hard copies of the audit. If you send us a hard copy of the audit this year, we're going to send it back to you. And so the only copy of the audit that they're going to want this year is an electronic copy of the audit. And so I will publish that. And so I'm going to take back with me tonight this sheet of paper, which is included in your audit, which is the certificate of board page 1. And I'll use that to make the official submission on y'all's behalf in the electronic format of the audit. Page 1 is that certification page. You will still need to sign some for your bond holders and such, because they, as far as I know, still are wanting paper copies of the audit. It's just TEA who is not. And so you'll still need to have some bound signed copies relative to that disclosure and filing requirement with the Municipal Advisory Council and so forth. Page 2 is the opinion letter, which just states the financial statements are properly stated in accordance with generally accepted accounting principles. That's a clean opinion. The letter beginning on page 3 is the management discussion and analysis letter. This gives highlights of this current year's activities. First couple of pages just define the financial statements and how they relate to each other. The first 2 exhibits, exhibits A1 and B1, those are called the government-wide or full accrual financial statement exhibits. The C exhibits are on the modified basis of accounting, the more traditional format that y'all operate on a daily basis, whereas the other 2 are on full accrual. Tables 1 and 2 on pages 5 and 6 compare this year's financial data from Exhibits A1 and B1 to last year's financial data from those same two exhibits last year. Table 1 is going to be the balance sheet numbers. And if you look on page 5, on Table 1, you'll see the extracts of the aggregate numbers by category comparing this year to last year. Current other assets are primarily made up of cash, and that increased from last year by $668,000. And again, you're going to see that number continuing to escalate as your values go up from year to year, assuming that those monies are not expended fully. Capital assets went up by $129,000. That's net of depreciation. Your gross asset additions are on page 7. Your gross capitalized additions to your capital assets were $312,000. You bought 2 buses, a couple of vehicles, the gymnasium improvements I did capitalize. You bought some equipment in the cafeteria, and then some technology equipment upgrades relative to your wireless connectivity. And you can see all those detailed out. Your liabilities on page 5. Your long-term liabilities went down by $91,000, and that's due to principal retirement on the outstanding long-term bonds that were issued, the refunded bonds that were issued at the beginning of this fiscal year in October. You made the first the principal payment on that, and that also includes amortization of the bond premium on that that was issued. Other liabilities went up by $38,000, and that's due to the accretion on the 1 year of capital appreciation bonds that are embedded within that new issue. That's a 1 year bond that will be paid this year, $180,000 of $90,000 principal and $95,000 interest. This is most of this line item in the other liabilities is the accreted interest portion on that bond payment that we do this year. Net assets, on the full accrual basis, you had a surplus of $851,000. On a modified basis, you're going to see a surplus of about $500,000. And that's a net of all the recapture costs and TEA overpayments. Revenues on page 5, bottom of the page, table 2, you'll see your total revenues are up by $379,000. Most of that's driven by your property taxes. Tax revenues this year were up by $560,000 in M&O and $17,000 in INS. And that again is due to valuation increases, not necessarily tax rate increases. Your operating grants went down by $85,000 because of the completion of the ERA stimulus programs. They were pretty much dried up this year. The only stimulus monies you had in 2011-12 was the Education Jobs Grants money, and that was a 1 year grant. All your other ERA stimulus programs went away after last fiscal year, and so that's why those numbers went down. Your state aid formula grants went down in step with in partial step with last year's growth in property values. That's where they've taken away part of that money this year, as well as the 7% state aid across the board cut to everybody. If your values and everything stayed the same, they were still going to lose some money from the state because of that statewide funding cut. Page 6, expenses. Your total expenses for the year, in aggregate, they went up by $64,000. They didn't go up much. And again, this is on the full accrual basis, and so this is inclusive of depreciation. And these $312,000 of capital additions that are on page 7 are not included in these expenses because they have been capitalized. Just the depreciation is included here. Most of the expenses increases were in construction. They were up by $69,000 due to payroll cost increases from last year. Student support services were up because of depreciation expense relative to the new buses that y'all bought this year. That's the depreciation on them. Child nutrition also went up because of depreciation expense on those new equipment additions. And the other items pretty much are the same. Extracurricular expenses were down because y'all bought a lot of athletic equipment and uniforms last summer, a year ago, that were not expended as much this year, so that's what drove those costs down this year. But overall, you had a surplus when you look at the bottom line there of increase in net assets of $851,000. The debt paragraph below the table on page 7 talks about the amount that was retired in principal and interest on the bonds and the defeasance costs relative to those that were capitalized. Page 9 and following are the exhibits, Exhibit A1 and B1. on pages 9 and 10, I'm not going to go over them because we just looked at those numbers in tables 1 and 2. But A1 is the balance sheet, B1 is the income statement that are in tables 1 and 2. C1 on page 11 is the current balance sheet. The difference in this balance sheet and the one that's on Exhibit A1 is this is just current assets and current liabilities. Does not include your capital assets nor your long-term debt, and so you won't see those on this balance sheet. And so that will change your fund balance, whereas on the net assets, your total net assets on page 9 are $4.4 million. The total fund balances on page 11 are $2.4 million, and that's because the net capitalized cost of the long-term assets and liabilities. General fund balance on page 11 is $2,325,000. Your debt service and food service fund balances, which are in the second column, are $82,000 for a total combined fund balance of all your governmental funds of $2,407,000. Page 12 will reconcile that fund balance to the one that's on page 9, and again it's going to be your infrastructure and long-term assets and liabilities. We'll be reconciling items to the net assets on page 9. Page 13, the income statement on a modified basis of accounting. Like I said earlier, this number is more than the $500,000 range surplus in the general fund. Bottom line was a surplus of $571,000 on the modified cash basis, whereas on the full accrual basis it was over $800,000 surplus. And that's because of those $311,000 were included in expenditures on this exhibit as a cash expenditure, whereas they're capitalized and depreciated on the other. In the other funds column, you had a net deficit in all your other funds combined of $2,300 for a net combined surplus of $568,000 for the year. Page 14 will reconcile the combined surplus from page 13 to the surplus that's on page 10. And again, it's going to be pulling out your capital expenditures and recording depreciation expense. And third item is going to be the changes in other uncollected property taxes and capitalized costs that are being amortized relative to your bond issue. C5 on page 15 will be your budget to actual comparison for the general fund. Had a budgeted surplus of $20,000, an actual surplus of $571 of the general fund, and most of those expenses are that change is relative to expenses not incurred that were budgeted. You can see the categories. Most of them are going to be instruction, and then plant maintenance and operations are going to be the biggest two that have positive variances there. Page 16 will be your student activity balance sheet, $45,000 in combined student organizational balances. Footnotes will be on page 17. Investments are listed on page 21. We don't have any hard investments at the end of the year. All of them are in money market accounts. $2.2 million at the bank here in Falls City, $2,220,000. Your capital asset activity again is on 23. Depreciation expense on page 24, and this shows how much per functional category has been allocated depreciation expense for the year. So when we look at Exhibit B1, this will show how much by function on Exhibit B1 is attributable to depreciation. A total of $182,000. Your bond activity is on page 24 and 25. You can see the refunding issue there towards the bottom of page 24 in that table. $1,235,000, which was the fees of your 2002 issue, and then you made your last payment on the 2002 issue of $155,000 in principal, and then $25,000 in principal on the new issue from an ending balance of $1,210,000. Bond premium on that new issue, unamortized balance is $116,000 at the end of the year. Page 25 will show you future debt service requirements on that new issue to final maturity of 2026. Your retirement footnotes on page 25 and 26. Your local revenues on page 27, footnote Q. Then you can see the allocation by category of your local revenues earned by the district. Most of it obviously is going to be property taxes. And then the other big long footnote there on page 27 is the TRS retiree footnote disclosure. Combining exhibits begin on page 30, and this is all of your other special revenue funds inclusive of your balance sheets and your debt service fund balance sheets that are aggregated into the other fund column on Exhibit C1. And likewise, the other column on Exhibit C3 are detailed out on H3 on pages 32 and 33. You can see the income expense by fund of all your special revenue funds and your debt service fund. And if you look on page 33, your debt service fund column, all the other financing sources and usage there towards the bottom of the page, in its column on page 33, that is all the activity relative to the refunding. Where the old bonds were retired, the new bonds were issued, the premium on the new bond, and then the prepaid interest on the new bonds because you issued them after the semi-annual date of September 1 or February 1st. The page 34 exhibit H9 is your student activity receipt and disbursement exhibit. Shows cash received and cash expended to the ending balance there for $45,000. Pages 36 and 37 is going to be your tax schedule, and that shows your growth in values for the last 10 years in column 3 on page 36, and then your current year levy in column 20 of $1,535,000. And then your uncollected balances of, at the end of the year, $15,000. And this is, I just had a comment just yesterday to another school that had about this schedule. And it's a school that's y'all's neighbor, actually, to the north. And their uncollected tax balances are over $500,000. And y'all's are $15,000. So you need to, your delinquent tax attorney that was just here and your tax collector, they're doing an unbelievably good job because not everybody is collecting taxes as well as y'all do. And this just kind of nails that point home when you look at your neighbors just to y'all's north and see their uncollected balances. And they're just like, how can y'all not get these monies? Why are y'all not repossessing these properties is what my first question was. The J2 exhibit on page 38 is the indirect cost schedule, shows your administration costs and how they're allocated amongst organizational activity. Your J4 and J5 exhibits on page 39 and 40 are budget tax comparison schedules for the food service fund, of which it had a surplus this year of $7,200. On page 39, and then page 40 will be the budget to actual comparison schedule for your debt service fund, and it had a deficit of $9,500. Compliance section begins on page 42. The only compliance issue is relative to you still have one non-highly qualified teacher on page 44, and that was the only finding this year. And so that's the audit presentation. Sorry, I spoke way too fast. I knew I was late, and I knew you were waiting on me. Questions or comments?
Cam, would you should suggest that we put $500,000 in restricted funds and in a fund balance again?
You're talking about committing future funds. I know in your current year 2012-13 budget you have roughly $900,000 in budget for future for construction and capital improvements. You can, TEA really has backed off a little bit on how much funds schools have because, quite honestly, I think they finally realized that they pushed too hard. They forced schools to cut costs, and yet none of the relief has come from them as far as you want us to cut costs, but you still want us to do all these things that you're telling us to do. And so from the seminars I've been to this last year, I have not heard hardly any comment at all relative to schools having too much money. Whereas last legislative session, that's all they talked about. Now then that buzz, I guess you could call it, has calmed down. And so I wouldn't propose necessarily that y'all do that, especially since you have that budgeted for this school year to spend that much money for construction projects this year. If you didn't, and we're not really going to spend that money, then that would be something y'all might consider doing. But if you're really planning on using that for capital improvements this year, then I would not commit it. So, what else? Good financial trade.
Numbers all look good.
I have not been to a school down here yet that has not had just an unbelievable year this past year.
It's a good thing.
Yeah, it is a good thing.
2 years down the road.
Yeah, that is right.